Welcome to Breaking News to Trading Moves. So, what happens when around 48,000 workers at a major memory chip manufacturer just walk off the job?
Well, I mean, the entire artificial intelligence hardware market kind of holds its breath.
Yeah, exactly. Today, we are looking at how Samsung Electronics just narrowly avoided what could have been a global supply chain disaster. They reached a tentative wage deal, which suspended an 18-day strike by their union members.
Right. And there is always a lot of noise surrounding semiconductor headlines.
Oh, for sure. So our goal today is just to look strictly at the mechanics of this specific headline. We want to map out exactly who wins and who loses based on the information we have. No exaggeration, just the facts.
I like that approach. To really evaluate the market reaction here, we have to understand the physical reality of what Samsung actually produces.
Right, because they are not just making smartphones or TVs here.
Exactly. In the context of this strike, we are talking about their fabrication plants that produce DRAM, NAND, and highly specialized high-bandwidth memory.
Wait, let's break down those acronyms for a second, just because the distinction really matters.
Yeah.
When you say DRAM, NAND, and high bandwidth memory, what are they actually doing?
Right. So think of it kind of like a computer's brain function. NAND is your long-term storage. It holds your data, your photos, your operating system, even when the power is off.
Okay, got it.
And DRAM is the short-term working memory. It allows a computer to access data quickly while a program is actively running.
Right.
But then you have high bandwidth memory, or HBM. And that is the critical piece for artificial intelligence.
Which is obviously what everyone's focused on right now.
Yeah, exactly. HBM is essentially, well, it's like a memory graphic cop. It allows these advanced chips to process massive, complex data sets without bottlenecking.
Okay, yeah, that makes sense. Because if you have the fastest processor in the world, but it literally cannot access the data fast enough, the whole system just stalls out.
Precisely.
So HBM is the traffic cop keeping the data moving, and if a strike takes that traffic cop off the road, the whole operation just grinds to a halt.
That is exactly it. And because Samsung avoided a prolonged strike, that absolute worst-case scenario is officially off the table.
Which means we can start talking about the winners.
Right. We have very clear categories of companies that benefit immediately from that supply stability.
Let's start with that first group of winners, the artificial intelligence server and data center hardware companies.
They are definitely at the top of the list.
To help visualize this, would you say it's like a busy restaurant that secures a guaranteed daily delivery of essential ingredients? Like, as long as the supply trucks keep arriving, the kitchen can keep serving meals.
Yeah, that is a great analogy. The semiconductor supply chain operates on just really unforgiving timelines. These data center companies, they don't keep big warehouses full of spare memory chips lying around.
Right, it's all just-in-time manufacturing.
Exactly. So when Samsung averts a strike, the risk of a supply disruption drops. These hardware companies can basically lock in their production schedules for the quarter.
Because they know the exact date their memory shipments will arrive.
Spot on.
So when you look at who breathes the biggest sigh of relief today, it is the companies building the infrastructure. We were talking about Nvidia, ticker NVDA.
Yep.
Along with Super Microcomputer, ticker SMCI, and Dell Technologies, ticker DELL.
Right. Because the primary supplier stays online, those companies do not have to rewrite their entire delivery schedules.
Which is a huge headache avoided.
Oh, absolutely. And that predictability translates directly to their ability to recognize revenue. If Dell, DELL, or Supermicro, SMCI, has an order for servers, but they are missing that HBM from Samsung, they can't ship the servers.
And if they can't ship them, they don't get paid.
Exactly. This wage deal allows them to fulfill orders without scrambling to buy parts on the open market at elevated prices.
Okay, so that establishes a pretty clear chain of events. If those hardware companies are successfully building and shipping servers, they are eventually going to need more capacity.
Right.
Which makes me wonder, what does that mean for the companies building the actual manufacturing machines?
Well, that takes us to our next category of winners, the semiconductor equipment companies.
Right.
The mechanics of semiconductor capital expenditure are highly complex. Building a fabrication plant or a fab costs billions of dollars and takes years.
And from what I understand, you can't just flip a switch and turn a fab off for the weekend, right? They run 24/7.
They absolutely do. If fab halts production due to a strike, the entire environment is compromised. Wafers currently in the machines can be ruined, the chemical processes get delayed.
Oh, wow, so it's a total mess.
It really is. So when a manufacturer faces that kind of chaos, the last thing they are going to do is accept delivery of a new, $100 million manufacturing tool.
They just pause all their capital expenditures until the crisis is over.
Exactly. But without a disruption to Samsung's operations, the broader capital expenditure cycle stays intact. Equipment suppliers benefit when chip makers continue investing in capacity.
Who are the specific winners here?
You are looking at companies like Applied Materials, ticker AMAT, Lam Research, ticker LRCX, and KLA, ticker KLAC.
Right, because they provide the equipment for fabrication, etching, deposition, and all that microscopic inspection.
Correct. Predictability is the best friend of a capital equipment supplier. Avoiding this strike means they can deliver their tools on schedule and recognize the revenue.
Okay, so the server manufacturers and the equipment suppliers are breathing easier. But artificial intelligence is really only half the story here.
Sure.
If Samsung's factories are running at full capacity, they're also churning out traditional storage chips. What about the companies exposed to PCs and storage drives?
Well, the dynamic is very similar for them. With the risk fading, companies exposed to PCs and storage hardware benefit from predictable availability, too.
So we are talking about HP, ticker HPQ, Western Digital, ticker WDC, and Seagate Technology, ticker STX.
Exactly. They are linked to memory costs and data center growth. They rely on a steady flow of those storage drives.
But wait, let me push back on that for a second. Predictable supply is great for buyers, I get that. But isn't it kind of bad for competitors who are relying on a shortage to drive up prices?
Yes, that is the exact flip side, and it brings us to the losers in this scenario. United States memory chip competitors lose a pricing catalyst here.
Because investors might have expected a strike to tighten the memory supply, right?
Yeah.
And avoiding it just removes that expectation.
Precisely. The clearest read-through here is Micron Technology, ticker MU.
Because they compete directly with Samsung in DRAM, NAND, and HBM.
Right. Micron MU still benefits from artificial intelligence memory demand, but they lose a competitive advantage today. Without the strike, they don't get to charge premium prices for a constrained supply.
Right, they have to compete on standard market terms. What about Western Digital and Seagate? You mentioned them as winners earlier.
Yeah, so Western Digital, ticker WDC, and Seagate Technology, ticker STX, they actually face mixed sentiment now.
How so?
Well, they like the predictable availability for their own manufacturing, but they suffer if pricing expectations for the products they sell become less aggressive.
I see. So it's a double-edged sword for them.
Exactly. And it goes beyond just pricing. Companies hoping for competitors' disruption also lose out.
Right, because if Samsung couldn't deliver, buyers would get desperate and maybe look for alternative chips.
Yep. Samsung can now defend its position more effectively. So companies like Intel, ticker INTCC, and Qualcomm, ticker QCOM.
They aren't pure-play memory companies, but a stable chip supply reduces the demand for alternatives.
You hit the nail on the head.
Okay, so we've covered the supply and the competitors, but there is a specific detail from the headline text that I want to focus on. The wage deal includes large bonuses for some of these Samsung chip workers.
Right, the cost of the deal itself.
Exactly. And my question is, if labor peace was achieved by paying out large bonuses, don't those higher labor costs eventually get passed down the line?
They almost certainly do, and that creates a very real problem for margin-sensitive hardware buyers.
Because if higher labor costs feed into pricing or supply contracts, those buyers face immediate margin pressure.
Exactly. They end up paying more for the exact same memory chips. The companies most exposed here are HP, ticker HPQ, Dell Technologies, ticker DELL, and Cisco Systems, ticker CSCO.
Because they heavily depend on semiconductor supply for PCs, servers, and networking hardware.
Right.
And I want to point out a recurring theme here for Dell and HP. They're actually listed as both winners and losers today.
It's true. They are winners because of the supply stability, but losers due to that potential margin pressure from the higher labor costs.
It just shows how connected all of this is. So to wrap this up, what is the primary takeaway here?
The key takeaway straight from the text is that this is a relief event for the global chip supply chain, but it ultimately creates a mixed trade.
Right.
Artificial intelligence infrastructure appreciates the supply stability, while memory chip competitors lose some of that scarcity premium.
It really is a delicate balancing act. Which leaves us with a final thought for you to mull over today. If labor peace in the tech supply chain comes at the cost of higher wages and bonuses, how will hardware buyers in the future balance their desperate need for reliable supply against the mounting pressure of rising component costs? This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.